Good morning. Welcome to the morning market briefing. Today is Monday, February 9th, 2026. Hope you have your Valentine's Day plans ready. That is on Saturday. So, friendly reminder, as Tom says, it is a DUI checkpoint. So, we have that on the radar this week, but we have a lot of other things on the radar this week. And I think that what we get this week may dictate to a large extent what we see for the rest of the quarter, Tom. We get CPI and we get employment numbers this week. And I don't think anyone's really thinking about them being meaningful determinants of what happens in the market. I think everyone's kind of been anesthetized to what they think is going to happen. But if you look at the estimates, the CPI on a core basis is going to be 2.5% for the month of January, which would be the lowest since March of 2021, the lowest in 5 years if we hit 2.5% on the core CPI. And by the way, that's down from about 3.1% just a couple months ago. It fell to 2.8%, and then we had the tariffs, popped up to 3.1%, and now is back down to could be down to 2.5%. And there are some people who think that it could come in, quote, hot because of beginning of the year things like people raising prices at the beginning of the year, and they think that maybe there'll be a delayed reaction to tariffs. What I'm seeing is kind of the opposite right now, with Pepsi lowering prices on Frito-Lay, General Mills lowering prices on 2/3 of its products. So we'll have to end up seeing what happens. But I think that the CPI, I mean, if it comes in as expected at 2.5%, that again would be the lowest in 5 years.
Yeah, I failed to mention this on the call on Thursday when we talked about Scott Bessent's testimony, but he used a great phrase, which is that tariff inflation is the dog that didn't bark. And we were kind of chatting a little bit back and forth this morning about how the thing about inflation is it's such a straw man argument because it could come back. It could be right around the corner, and we don't even know it yet. But the problem was when we did have inflation, nobody seemed to acknowledge that, one, we were in it and it was extreme and that it was not transitory. And so we've now been on this downward path, and the fear is now, oh my gosh, we're going to get crushed by that. And that's how markets go. You know, everyone is still waiting for the next housing crisis because of 2008. Everybody anchors to the most recent thing that hurt them the most. And so the market is very jittery about inflation, even though when inflation was as high as it's been in my lifetime, people are like, well, it's going to go away really quickly, you know. And so that's where I fail to get that. You have to think about it rationally. I can't reach other people's levels of fear about something that just happened. You know, it's almost like we have natural immunity. A lot of people, I don't know if you guys are familiar with this concept, but we just had massive inflation. The odds that we get massive inflation again are pretty low because we're all looking for it. We've got the antibodies. And so I think that's something to be cognizant of when you have to think rationally about things that could get you, both biological and financial.
And so when you think about how the Fed responds to all of this, on Friday, we won't get the CPI inflation number until Friday morning. But on Wednesday, we get the employment number that was delayed from this last Friday. So this would be the employment for the month of January. We already had the ADP private sector employment report, which showed outside of healthcare a net loss in jobs. In the national numbers, we've had an average net loss of jobs of 22,000 per month over the last 3 months. Right now, the unemployment rate is expected to hold steady at 4.4%, and 50,000 jobs are expected to be created. But, you know, I would kind of take the over on the unemployment rate. People are now being paid. There was a big article in the Wall Street Journal. People are now not getting recruited by recruiters, but they are paying recruiters to recruit them instead of like a company paying.
Yeah.
And they'll pay like 20% of their first month's pay once they get a job. That is totally different. I mean, this is like going from paying over list price on a house to getting massive concessions from someone trying to sell their house. So if you're going out to pay a recruiter to get you a job, that is a big change from where we were. And it speaks to the dynamics in the employment market. And specifically, it speaks to the dynamics in the white collar employment market.
Yeah, there were some reports over the weekend that some of the investment banks were giving no or just sort of paltry bonuses and sort of accelerating. We had the quiet quitting era where people were, basically looking for other jobs and not really doing their job when people could, switch and get big pay increases. But now you're seeing the opposite, which is that companies are essentially putting you in a box and hoping that you quit by making your life miserable. They're quiet firing you, either by not paying you a bonus, or we talked about it last year with AT&T basically making everyone move to Dallas, even though a huge portion of their employee base is here in Atlanta because AT&T used to be based here. So it's interesting because we have this weird dichotomy. Everything is different than it has been in the last 6 months or so, just with unemployment ticking up, inflation's ticking down. The Mag 7 is not really leading the stock market. I don't think that I would be living my true self if I didn't talk about all the big breadth I've been seeing in the market. I'm a big breadth guy. But we're seeing for the first time the winners in the S&P 500 start to spread out away from the Mag 7. So right now we're at 89 of the 500 stocks. About 18% of the cohort is at new 52-week highs, which is not something we've seen in quite some time. And basically the entire market for the last 4 or 5 years has just been the Mag 7. If you didn't own them, you're underperforming. If you didn't own enough of them, you were underperforming. And if you own anything else, especially things that underperform the S&P 500, you were behind. And it made it really difficult to manage portfolios. You would be up, obviously, if you own them, but you would probably be lagging the market. The opposite is true now. The Dow is up almost 4% before the market opens today. The S&P is up about 1%, and a lot of that is the fact that a lot of Dow components are considered sort of old, sleepy American companies, and they don't, necessarily reflect the semiconductor revolution of the last 5 years. And so that's something that I'm really keeping an eye on, especially as we get in this new environment where we're not inflationary. We're seeing unemployment. Everything is almost the opposite of what it's been the last 5 years, and we really need to be paying attention to that because that trend, if it becomes sticky, is going to be pretty interesting going forward. It's going to be a real stock picker's market because you can't just be like, I own NVIDIA, Google, Apple, Microsoft, and Amazon, and I'm going to be just fine. And you've got to actually have some other companies that are making money and have just been thrown in the trash pile of history, but now are suddenly back.
Rick Reeder talked about this last week, saying that the dispersion in outcomes when earnings estimates are as high as they are actually widens out. And so that speaks to what you were talking about. Sticking with the bond market, though, Tom, with the CPI number on Friday, with the jobs number on Wednesday, I do wonder if we can get some interesting things happening in the bond market. Right now, the bond market's selling off. Or at least it was earlier this morning. The reason for that is the Chinese have warned their financial institutions to be wary of investing in U.S. Treasuries. Now, the Chinese have actually been they haven't really sold U.S. Treasuries, but they have allowed them to shrink as a proportion of what they hold, as well as the proportion of Treasuries that are out there. Right now, I think they own about 2 or 3% of U.S. Treasuries. But they are warning their financial institutions not to buy them, specifically because of concentration risks and market volatility. Now, the market volatility piece is interesting, and we have a chart on this, Hicks, if you want to put this up. This is a chart, the MOVE Index charts historical bond volatility. And if you look at that, what you can see is that over the last couple of years, we've seen bond volatility go down, not up. Indeed, it's down to about levels where it was in the late 2010s, and certainly below where they were, before the global financial crisis. So, to me, I think that this is an excuse for the Chinese to kind of try to hit the U.S. where it counts ahead of another meeting between Trump and Xi coming up in a month or so. Because as I look at it, Tom, I see the U.S. We're going to get U.S. budget balance numbers on Wednesday afternoon. That is expected to be a smaller deficit than last year by about $35 billion. And I think it might actually be lower than that based on what I'm seeing coming in and out of the Treasury. So last year we ran a $130 billion deficit in Biden's last month in charge. This year it's expected to be $89 billion. So actually about $40 billion in a smaller deficit. And then as I'm talking through this, there's also a lot of people complaining that Warsh is looking to cooperate with the Treasury, and basically there's going to be some shady backroom deals with essentially monetary financing, to which I would say, first of all, I think that it makes a whole lot of sense for the Federal Reserve to know what the Treasury is going to issue, because the Federal Reserve needs to know how to maintain liquidity in the system. But secondly, if we have if that's monetary financing, and what happened in 2020 when we printed a lot of money and then gave it out, or what happened in 2008, or what happened in 2010 or 2012 when we had QE1, QE2, QE infinity. I mean, all of that was the same thing. So I don't know what's really different there. But the Chinese are concerned about U.S. bonds. Bloomberg seems to be concerned about U.S. bonds. I'm not, and I'm bullish.
Well, the one thing that Bloomberg and China have in common is they hate America. So keep that in mind. I'm not really concerned about it. I think that if anything, the Fed should be working with the government to use the Fed to benefit the government. That has not been the case recently. We've talked a bunch about how the Fed is essentially running a massive deficit. They're supposed to have a balance sheet. That balance sheet makes money, that those proceeds offset the deficit. Right now, they're running a massive hundreds of billions of dollars in IOUs, but those IOUs are actually back to themselves. So when they eventually become profitable, they then got to make up all of the losses that they've had, and then eventually they can start helping the government again. So in my mind, if Warsh and Bessing can work out a deal where the Federal Reserve actually starts benefiting the government again, that's probably a good thing, and it's something that Jay Powell has not been interested in doing. Also, in terms of holdings, I mean, China's quietly walked down the holding list. There's been this, China owns all our debt. They could call that debt. We're going to be in big trouble. I mean, the Social Security Administration owns the largest proportion of the U.S. Treasuries. It's somewhere in the neighborhood of, I think, $5 to $6 billion bucks. Then you get the Fed balance sheet. Trillion, sorry, with a T. As I've said, we're in the era of big numbers. It's easy to get confused. Federal Reserve has another 5 probably, and then you get the mortgages on top of that. And then Japan has about $1 trillion. UK has a little less than $1 trillion. And then you got China, which I think is somewhere around 600-700 billion. So I think we'll be all right. I mean, it's just they aren't what they used to be. They don't have the economic leverage they used to, and that's fine. And also, if issuance drops because the amount of money we're overspending comes down by the tune of, call it somewhere between $400 and $500 billion this year, then that offsets the Chinese completely, and maybe rates just stay sideways, which I would be perfectly fine with, because there's plenty of great opportunities, particularly on the long end. But if inflation continues to come down, go ahead, sell those treasuries. I'll buy them, and then when rates come down, you will have made no money, and I will have made money, and that's fine with me, because unlike China and Bloomberg, I don't hate America, and I actually think we're in a pretty good spot, because we're in the era of big breadth, which I'm a fan of.
We would be remiss also on the subject not to talk about Japan. There is a concern about Japan's government bonds. Well, they had an election over the weekend. The incumbent LDP, Liberal Democrat Party, run by Sanae Takeichi, who took over in October, just stomped to victory. I mean, to a staggering degree. In fact, the biggest degree, the highest proportion in the lower house that any party in post-war Japan has enjoyed. This should stabilize the yen, I think. I think this should stabilize government bonds. Some people are concerned about this and freaking out, and how they're just going to pass through all these things to help the economy. But to me, that's good. I mean, I just think that the fear of the lack of, if you're not on my side, the fear of what's going to happen is just so palpable. And we have this on both sides. I mean, this happened over the last 4 years under the Biden administration. There was a fear on one side about what terrible things are going to happen, and everyone survived.
Not the dogs and cats, though, unfortunately.
Yeah.
Prayers up for the dogs and the cats and the gooses in the park.
And I think that people are going to survive again. So both in Japan and here in the United States. One thing that I am positive about, and this is just kind of my own opinion, but I also think grounded in moral and legal clarity, and that's the GLP-1 copycats on weight loss have gone way too far. I mean, you're taking something that was developed, patented, and there was a reward to all that intellectual property and research and development that went into that drug, and making sure that it was safe for people. And now then you have people coming out and just compounding that same drug for a fraction of the cost. I made this analogy, and it would be like if Tom goes out and builds a house, he buys the land, he builds the house, and he's getting ready to sell it. And I say, I'm going to sell that house, and I'm going to sell it at half the price that Tom did because I didn't have to spend the time and money building it. And that would be like developing a drug and then having someone else just undercut it. And it's 14 years, and I know the pharmaceutical industry needs to be regulated to an extent, and then it has to be competition, but it's also what drives innovation, is the profit motive. And so,
man, Ben is for big regulation. You heard it here first. He wants to make it harder for you to build a house.
So
hashtag part of the problem.
So what I think is, I think the FDA and the Department of Health and Human Services is doing a really good thing right now, finally cracking down on a lot of these generic pharmacy compounders when you cannot legally generically compound Mounjaro or Zepbound or Ozempic or Wegovy today. You can wait 10 years and then do it until the patent expires, but you cannot do that today, and it's just been driving me nuts.
Nah, man, I'm pro Hims. I want everyone to get teed up, skinny, tan.
I mean, there are things that are fine, like things that are generic are fine, but I mean, you can't just develop something and then have someone undercut it and steal it from you.
Man, if only the big baking had prevented people from making chocolate chip cookies, Betty Crocker could have made so much more money, you guys. She developed those cookies. She made sure they were safe. And then some guy came in and just made his own cookies. What an absolute monster.
I mean, you
I mean, I'm taking the opposite side of that. I like Eli Lilly too. I just think that, I think they're making a lot of money, billions and billions of dollars a quarter that, these things could benefit people.
Then what Hims should do is they should also go through the regulatory process and get a drug approved.
I mean, the guy who came up with the polio vaccine gave away for free, and it only gave like 50 million women uterine cancer. But he's a hero, And they put some sort of weird monkey drug in it that makes cancer more prolific in humans. Look it up. But he gave it away for free, so he's a hero.
People do love Jonas Salk. Stephen Moran's talking 3 times this week. He's by far the most active Fed member. I can't wait if unemployment comes in hot and CPI comes in cold. He is going to have a field day saying the Fed needs to cut 300 basis points. Someone who will say that regardless of what the data say. We also get the NFIB Small Business Optimism Survey. One thing that we didn't talk about, Tom, because we've talked about it a lot, but now that it's kind of agreeing with us, we're not talking about it, and that's the University of Michigan Sentiment Survey. I forgot to talk about this in the inflation update, but University of Michigan inflation fell from 4% to 3.5%, which by University of Michigan standards is like 0.
Total capitulation is what they call it.
But I do like to look at the rate of change on that, and you're seeing that in even consumer survey data, we're seeing dramatically lower expectations of future price increases.
Do you think that the same respondents who were screaming and yelling that we're going to get 9% inflation a year ago in their survey are the same people who were screaming and yelling at Frito-Lay and had them bring down the price of Doritos last week? Because
it might
now
well
that now the Doritos are cheaper, they're like, actually, inflation isn't so bad. I'm getting my red 40 at a reasonable price.
It's a reflexive thing, man. The Lay's commercials I thought were a little bit lacking.
Was that the farm one where the potato?
Yeah, I didn't get the emotion of it.
No,
I mean, I grew up in potato farming country. I know potato farmers. I could smell. My neighbor owned the potato factory.
Many potatoes.
Like the potato factory that sold into like McDonald's and
I'll tell you
starches.
what I thought was the best commercial was the Mike Tyson eatrealfood.gov, where he's like, I was 300 pounds, I was fat and floppy. I was like, hell yeah, let's go, Mike.
I think I was attending to household duties at that time.
Yeah. It was awesome. You should look it up. I thought it was very effective.
Speaking of the Super Bowl, Seattle are Super Bowl champions. I know there was another podcast who we have collaborated with in the past, and I would be very keen to collaborate on with the future, unless he's too sad and doesn't want to talk about what a great victory it was for the Seattle Seahawks and how it was never close and how it was never going to be close. So we can talk about that on Friday if that podcaster would like. So that's my open invitation to him. Have a great day. We'll see you tomorrow. Bye.